This is LONGave, featuring technical analysis and market analytics by Gordon T. Long, editor and publisher of GordonTLong.com. The content of this presentation is strictly the opinion of Gordon T. Long and is based on his analysis, which he feels to be accurate and unbiased. Participants may or may not hold positions in any securities that are discussed. You should always consult a registered investment advisor before making any investment decisions. Now, let's join Gordon for today's show.
Good morning. It is Wednesday, July 6, 2016. I'm Gord Long at GordonTLong.com. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscribers' reports so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals, in the intermediate term, risk, and in the short term, confidence and sentiment. This month, I'd like to cover a range of topics listed here. I'd like to talk about the natural order or patterns within the chaos that help you identify what may be coming within reasonable degrees of probability. I'd like to talk about drawdowns, how they come about, and that they don't come out of nowhere. They're usually signals coming from other markets if you're referring to the equity market, but coming from either the currency, the credit, or the bond markets. And I'd like to then examine specifically some currency pressures that we see in various areas, and then what to expect going forward in Q3. An important part of being a market analyst is not to be caught in the day-to-day market noise, lest you won't be able to see the forest for the trees. It is only when you step back that you often see what have proven to be reliable patterns that offer a level of market predictability. There are never any guarantees, but there are levels of probability. Two such patterns are rounded tops and head and shoulders. They have proven very reliable if identified correctly. The drop from a broken neckline is to be fully expected in such a case. Rounded tops often accompanies a head and shoulders, but not always. We see here such a case where in addition we have global stock prices diverging significantly from the global bond yield. This is a telling divergence that is seldom not corrected. But of course we all know it will be different this time. Each time it is going to be different because of some false belief. There was the dot-com bubble and how the internet was going to change everything, including old valuation models based on earnings and not eyeballs and page views as the new metric. There was the 2000 financial crisis centered on the housing mortgages and how we were all told housing would never go down because everyone knew and the real estate agents kept preaching, you know, they aren't making any more land, right? Patterns then were clear. But we've refused to trust them. It's always the case. We refuse to trust the patterns. The Megaphone pattern is another trusted and often reliable pattern. I have laid out previously how this pattern has been present in a significant number of instances where we had dramatic market drawdowns. We have witnessed the unfolding of a 1.5 decade long Megaphone pattern, which I have been reporting on since the 2008 financial crisis. It has served us very well since then, throughout this protracted market rise. The pattern is nearing an end, however, or at least it appears to be. When exactly will it end, and how do we determine that? One of the better ways to understand and how to answer that question is to look for fractals. Fractals are nothing more than repeating patterns of various degrees, where a degree is often just varying time frames. What we would expect if our multi-decade Megaphone was ending was to see Megaphone tops ending at smaller degrees, all coalescing at the same point in time. That's what you hope for, that's what you would expect if you really have got a high probability occurrence. Here, for example, we see the Megaphone top ending in a period from the end of 2015 to today. Here we see the same Megaphone pattern approaching a culmination when we see it occurring again in the time frame since mid-April. A shorter time frame as we drill down, but you see it's not quite complete. This is the sort of thing that makes technicians sit up straight and quickly get seasoned investors paying attention. This doesn't happen very often. Another pattern we have found very useful is the ellipse, especially where fractals are involved. Here we have changed the scale so the larger ellipses are actually shown as circles to better mirror Gauss analysis and what it refers to as the square of the circle concept. You will notice, however, a smaller ellipse at the exact center of the bottom, which, by the way, helped us identify what the post-Brexit pattern was likely to be in the US dollar, this being a US dollar chart. These ellipses, if they're truly drawn and are correct, follow very specific patterns closely. Not always, rather often. Here we see the US dollar chart at the 60-minute degree level, much smaller. And once again, we see that ellipse, which helps us with the path we can expect when coupled with the trigger high probability trading zones, which we use exclusively at triggers. Let us return to our Megaphone top for a moment. Here we see the U.S. Transportation Index going back to 1994. It would appear that in the beginning of 2015, right at the beginning, this Megaphone pattern topped and has been setting up for a drop ever since, continuously weakening. When you examine the shipments in trucking, bimodal rail traffic, rail haulage overall, air freight, cargo shipping, Baltic dry rates, it is obvious the degree of global slowdown presently occurring, and we would expect this in the transportation index. We see here our Megaphone top, but it topped in the Wilshire 5000 a little later, but still relatively early 2015. Often market weakness is seen first in more risky, smaller capitalization stocks as represented by the Wilshire 5000. Is this what our Megaphone was signaling back then? Here we see a slightly distorted Megaphone top in the Russell 2000. The top here was seen later. Not significantly later, but later, occurring in mid-2015. This again would be what we would expect, but the new top is not again achieved even during major market rallies since mid-2015. What we have in the previous slides is order within the chaos. If you look at the patterns carefully and look for repeating patterns, they're suggesting something here. Let's shift from these technical patterns to cycles. I've talked for some time that the credit cycle has turned. Currency and credit markets always lead. The bond market follows, and like the tail on a dog, the equity markets are often whiplashed as they follow subsequently. A year ago, the Financial Repression Authority was invited to Camp Kotok in Maine, where a who's who of the financial world comes to fish and informally talk macroeconomics each year. It is by invitation only and is dominated by money managers who understand the bond market. Everyone was asked last year to present where they saw interest rates on the 10-year U.S. Treasury being in 1 year's time. Everyone at the session was calling for rates ranging from 2.25% to 3.5%. The Financial Repression Authority, on the other hand, stood alone and presented a forecast at 1.25%. Everyone was polite, but clearly we were the fools that every such conference must have to raise everyone's self-important view of themselves. Well, it appears this year when we attend in August we will be very close to 1.25, as we are now trading at 1.32 as I write this, and will be awarded a plaque. I'm sure everybody will be looking and asking where we think rates are going, as we're showing in this chart 12 months from now. It isn't that we are that smart, but rather we don't listen to the macro narrative of the day, which changes regularly, nor just to the technical charts. Rather, we overlay all of them, and often out of the chaos of patterns, we determine what the high probability occurrence is, and to have measured milestones during that process. The pattern was clear to us that was supported by currencies and credit was an ending diagonal here, and it's important to stress that was supported by what we saw was going to happen in the credit markets. We found order within the chaos. What we look for is currency pressures. We look for currencies and currency crossers under serious stress for any number of reasons. Once these are identified, we consider them potential drivers and then work from there. Presently, we see the Chinese yuan to be under considerable stress. Whether the Shanghai Accord, which we talked about before, or the 7 stealth devaluations in approximately the last 60 days, we see China desperate to lower the value of the yuan. Mounting capital flight, weak exports, weak capital formation, and many other indicators all suggest a major devaluation may be ahead and is likely ahead. We see mounting pressures in the Japanese yen, specific to the Japanese yen Chinese yuan cross. The strengthening of the yen and the weakening of the yuan are creating serious problems for Japan, which is already facing economic growth and export weakness. This rate of growth cannot be sustained much longer without something seriously breaking. Another growing problem is the euro-Japanese yen cross. European banking is in trouble, and European funding by the Japanese carry trade is urgently required. Europe is heading for levels not seen since the early 2012 and the floor of the last European banking crisis. Something must be done, money must be found, and it's going to put pressures on some elements of the currencies. We think there's a problem here in the euro-yen cross. The strong dollar has wreaked havoc around the world, and especially in emerging markets where approximately $9 trillion in US dollar carry trade since the financial crisis has turned against them. The US dollar must be weakened globally, some way, some fashion. The question is how and by when. These are the drivers that need to be considered in light of the equity megaphone patterns we discussed earlier. Remember, major financial events start in the currency markets and the credit markets. Look there first, find a strategy, and back into the yield curve and the bond market. The US dollar Japanese yen has been leading the market for some time, but has recently diverged from the US equity markets. This is an important development and must be considered carefully. Also, the U.S. bond market has clearly diverged from the U.S. equity market. The post-Brexit bounce was completely ignored by the bond market. If the currency and bond markets lead the equity markets, we should be giving these patterns their due and proper attention. As I've said, it is my opinion that the credit cycle has turned, and additionally the business cycle is now turning. These are serious headwinds for the global central bankers to overcome. But never fear, you can always count on the government to print more money the moment the opportunity presents itself. That time may once again be close at hand, so always be prepared and looking for that to occur. I'd like to take a moment as a reminder, do not trade from any of these slides as they are for educational and discussion purposes only. Thank you for listening, and until next month, may 2016 be an outstanding investment year for you. Thank you for listening.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.